Hello, everyone. It's Thursday, October 20th. Today on the Final Bar, we're talking with Jeff Hughes of JWH Investment Partners. We'll look at some charts, short-term to long-term, putting these moves into proper context. A lot of choppiness, net negative today. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very smoky Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the language of stock charts, using the technical toolkit to focus on the evidence that the markets provide back to us. When we had ChartCon recently, people like Ralph Acampora, Larry Williams, Linda Raschke, Martin Pring, many others kept reinforcing the message of focusing on price, and I think that's super appropriate. I was asked in an interview earlier today to comment on the action in the equity markets this week, and my comment was 4 out of the last 5 sessions, we've had a pretty strong open, the first 30 minutes, pretty good out of the gates, but then only to peter out and just have a weakness or general lack of strength through the rest of the day. So that initial spurt, usually a reaction to overnight earnings and things like that, then just dissipating through the course of the day. Buyers just not coming in and pushing risk assets higher. We're seeing that continue today as interest rates continue to push onward to the upside. Let's talk about who's coming up on the show. I'm excited to talk to Jeff Hughes, one of the best. Always brings some charts to make you think. Next week on Tuesday, the 25th, we have Bruce Frazier, Wyckofian and educator, give us a Wyckoff take on the markets. On Wednesday, the 26th, Miss Schneider of Market Gauge. We'll share with you some of the items she's paying attention to. And then on Thursday, Jesse Felder, editor of the Felder Report, will be coming back on the show. Always bring a couple tickers that are always interesting to pay attention to. So great guests going through the remainder of this week and next. Let's continue on our show today with our market recap. Let's break down what happened in the markets and as much as we can connect the short-term movements of today with the long-term trends and how they're evolving. Let's get to the charts. The S&P finishing down today, 0.8%, finishing around 3665. That's at the lows of the day. And as I mentioned in the introduction, if there's something I would use to describe the last week of trading, I would say short-term upswings just completely not seeing follow-through. And a bull market phase, you see upswings and then there's follow-through. There's this indication that buyers are just super anxious to buy and they're coming in force. That is not the evidence I've seen on a lot of individual charts and certainly not on the major averages. You're seeing any signs of strength essentially be sold as you see further deterioration. That's the sign, in my opinion, more of a bear market phase. And I think that gives me further caution to any sort of optimism you may be feeling on these bounces on stocks like AT&T or Lam Research, any of these that are sort of bouncing higher today. The NASDAQ a little bit better, but still in the red. The NASDAQ composite down 0.6%. Mid-caps and small caps almost doubling the negative move on the S&P today, with the mid-cap index down 1.5% today. And the VIX actually was down today, even though it usually moves inversely to the major averages. Today, you actually had the equity indexes moving lower and volatility declining as well, still fairly elevated and above 30, which is a key level we've talked about many, many times. If there's a story to today besides the lack of buying conviction, I would say it's higher interest rates. 10-year yields now at 4.23, which is the highest level we've seen in quite some time. You have to go back to 2008, if I remember right. The last time we've seen the 10-year yield this high. So you've certainly seen interest rates continue to push higher. We still have that inversion with 5-year yields well above that, around 4.45. The dollar index, not too different from yesterday, but I think the story is really higher yields, weaker bonds. And as Martin Pring put out in a note earlier today for our Stock Charts premium members, paid subscribers, it's all about the bond markets, right? As long as rates go higher, it's hard to imagine that stocks mount this big recovery. In this sort of environment where you see stocks moving lower and bonds moving lower, you usually see a move in bond markets first. And so seeing bonds rally, seeing rates come down would often open the door for equities and other risk assets to start to improve. So that potential leading indicator for stocks not triggering yet. You're seeing bonds continue to push to the downside, with the ag making a new 12-month low today. Gold flat, silver up a little bit, and the rest of the commodity complex actually doing okay. Energy was one of the better sectors today, but none of them really had a lot of upside to speak of. Although if you look, a lot of earnings this week, of course, in a number of different areas. Some of the top ranked stocks in our scooter rankings are all in the energy sectors. We highlighted Dino yesterday, DINO. We have Petrobras as the top ranked name, COP also in the top 10, and so forth. Cryptocurrencies continue to chop around. So if you're looking for some sign from cryptos that everything's fine and that speculation is alive and well and that there's a lot of upside for risk assets, I don't think you're getting that message from cryptocurrencies. And what we've talked about, and I think my guest on Tuesday's show, Dana Lyons, did a great job just sort of reinforcing that idea of a line in the sand, right? At what level do you agree to revisit a thesis or revisit a particular chart? For me and Bitcoin, it's 20,000, right? If Bitcoin gets above 20,000, that's an alert I have set up on StockCharts. I'll get a little pop-up on my screen. I'll get an email. I'll get a text that tells me that has been triggered. I have not had that trigger yet, which tells me that as exciting as anything may be day to day, until you get the market sort of pushing through a key level, it tells you to sort of hold off and wait and be patient. I think with Bitcoin and Ether prices, we're not really seeing that upside follow through, certainly just yet. Previewing the charts with my guest today, Jeff Hughes. I know after the break we're going to dig into the S&P 500 a little bit, so I don't want to go too much deeper into that, but only to reinforce visually what we mentioned in the introduction. A bull market phase, in my opinion, you see follow through, right? And that's a word I would often want to use to describe a bull market phase. Go back to 2021. If you can remember what a bull market felt like, 2021 is a good example of that, right? You have upswings, you have pullbacks, but then you can see just on the chart, you can see the evidence that investors are buying in on the dips, pushing the market to new highs. You saw that on the major indexes, but you also saw that on individual stocks. Now in 2022, and particularly in the last couple months, we've seen the opposite, right? After the August peak, we've seen more follow through to the downside. You've seen bounces, right? We saw one in early September. We saw one in early October. We've now seen one in the last week, but they've been short-lived. And they've often, after the gap higher, you're seeing these days where it's sort of a down close, right? You open, but then you're not moving higher there, right? After the higher open, you're seeing the market move lower. In the last 3 days, we've seen a close below the open. Even though we gapped higher on Tuesday's session, we still finished more on the lower half of the day. And again, that just tells me that there's distribution happening in the market. It's not accumulation through the course of the trading day. Going back to the market recap and what we saw today on a sector basis, very few sectors in the green. Communication services is actually the best performing sector. And I would say that's in no small part on AT&T coming off of earnings. Pretty decent report, up 7.5%. Before we get too excited about a chart like AT&T, I'll tell you the same thing we talked about with cruise lines and other names that are gapping higher. Is this encouraging? Of course, right? Is it better to gap higher than lower? Absolutely. What would make me more interested in a chart like this is we put in a higher low, right? Indicating that when we pull back, we're not making new lows anymore, right? And that's the concern with some of these charts. They're gapping higher, but there's not a lot of follow through. I'd be very interested to see tomorrow, which is a triple witching day, which tends to be kind of noisy and choppy. Do you get follow through to the upside on a chart like this? Can we regain a moving average? We closed above the 50-day moving average today for the first time since July. Do we hold that tomorrow? Those are the kind of questions that would make me more confident that it's not just a one-day move, that it's actually following through, and that we're seeing buyers willing to take additional shots at a chart like AT&T. Besides that, most things in the red. Energy and technology were flat for the day. Everything else pretty red here, with utilities leading the way lower, down 2.5%. After that, industrials and consumer discretionary both down over 1.9%. So interesting as we look at the day here, again, gapping or moving higher out of the open, but distributing through the course of the day. Again, it just reinforces that concept of being fairly skeptical of market upswings. Having said that, we're entering into the seasonally strongest part of the year. We're in a midterm election year, which means The random playbook, the regular playbook of this year tells me November and December should be strong. When we come after the break with my guest, Jeff Hughes, we'll talk about what he is seeing for the remainder of 2022. I'll come back after the break with Jeff Hughes. See you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We're going to bring on today's guest, Jeff Hughes, in a few moments. Before we do so, a couple quick announcements. First off, we welcome your questions. You can email us your questions at thefinalbar@StockCharts.com. We're on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll hope to answer one of your questions live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. It's interesting as overall bearish we've been on the markets on our show and in our work with our premium members. Larry Williams put out a special earlier this week, literally titled Up and Away. So there are very different ways to approach the evidence that we're seeing. I would encourage you to explore different perspectives, and StockCharts TV hopefully provides you many of those. Go to StockChartsTV.com. And you can register for free there or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, a frequent guest on the Final Bar, Jeff Hughes. Jeff is the Chief Investment Officer for JWH Investment Partners, editor of Alpha Insights, coming to us from Minneapolis. Jeff, good to see you. Welcome back to the show.
Great to be here, Dave.
So we're talking Elliott Wave today, and I appreciate you always do such a great job of helping us understand the structure as you see it. Help us make sense of what you're seing today. Talk us through your chart if you could.
Yeah, absolutely. So this is a one-year daily chart, just really looking at the daily range going back to the beginning of the year. The market topped at what we believe to be at least cycle degree in January of 2022. And, we think by extension, potentially super cycle. And so, we're really counting this thing down using the Elliott Wave principle, which is, basically a framework that allows us to map out the ebb and flow of the market. Directionally, we look at 5-wave patterns that are known as impulse patterns. And then on a counter trend basis, we look at corrective patterns, which are only 3 waves. And when we count it down, we get to a terminal point in June, which we've identified as the end of primary wave 1. And that was followed by a 3-wave counter trend advance into the August 16th high, which we've counted as primary wave 2 down. And so now we believe that we're in the early innings of primary wave 3 down. And most likely last Thursday's key reversal day marked the end of intermediate wave 1 of primary wave 3 down, which means that we're in a counter trend advance right now that is very likely intermediate wave 2. And so we've highlighted a couple of key resistance levels that we think could mark the end of that counter trend advance. The first would be the 38.2% retracement level. And that kind of coincides with a couple other key levels. A previous 4th wave extreme at one level of trend or 1 degree of trend lower, as well as the 50-day moving average. This is the exponential version. And, our sense is that if we do break through that level, then we could see an advance that takes us all the way to the 61.8% retracement, which would be about 200 handles higher. So there is some risk to the upside from here. And we basically told our clients that this is a tradable rally, but, we should expect surprises to be to the downside in a bear market.
It's really interesting, the confluence of levels right around that 3,800, a little bit above there with the moving average, along with previous resistance, Fibonacci retracements as well. Now we're getting into a little longer term time frame, Jeff, with your weekly and your monthly charts, right?
That's right. When in doubt, Dave, zoom out. And so what we decided to do is take a look at this picture from a 3-year weekly perspective on the left and a 13-year monthly perspective on the right. And I don't think it's any real coincidence that both are Fibonacci numbers. But on the left side of the chart, what we're looking at is the corrective move of the advance that began on March 23rd, 2020, the COVID lows, if you will. And that advance, in our view, was really primary wave 5 of cycle wave 5. And so if we're simply correcting that level, we've pulled back 50%. Okay, so we've seen a 50% retracement. We've broken through the 200-week exponential moving average and the simple moving average as well. And that was a great place for us to get a bounce. We had previously identified a classic pattern top formation of the head and shoulders variety, which counted down to 3,500. And so our expectation was that we'd find some support around that 3,500 level because of all of these support confluences. But we think once we're able to consolidate around that, the next break to the downside could carry the S&P all the way down into the mid-2000s to mark the end of primary wave 3 down. And unfortunately, that won't be the end of the decline if this count is correct, because if you look at this from a bigger perspective, a 13-year perspective, looking back to the 2009 lows, so far we haven't even retraced 1/3 of that advance. Typically, if we were going to correct, a bull market advance, you would correct somewhere between 1/3 and 2/3. We often use Fibonacci levels, 38.2% or 61.8%. If we were to retrace that 618, Fibonacci retracement, that could bring us all the way down to around S&P 2250, which coincides with the 200-month moving average and a previous fourth wave extreme at one lesser degree of trend. Again, a typical level that we would consolidate. But that's not all, folks. Dave, we would expect that to be wave A of a 3-wave corrective pattern, which could carry the market even significantly lower.
I hesitate to even ask you questions about these next couple arrows in here, but I totally get it's quite an unwind of what we've done leading up to this point. Your final chart kind of addresses the why, and that would be my obvious question is, people are frightened by how far we've come down already. What could propel us further? Talk to us about liquidity.
Yeah, I think the withdrawal of liquidity, which is basically the antithesis of what propelled us up to those high levels at 4,800. In other words, we pumped $5 trillion of liquidity into the market through the Fed's balance sheet. And the Fed has basically told us that they're going to withdraw the majority of that liquidity and bring it back to the pre-COVID levels. In fact, Charles Evans of the Chicago Fed said last week that he expects that unwind to be complete in the next 3 years. So I think we've got a major headwind ahead of us. Now, the Fed's plan is to withdraw about $95 billion of liquidity every single month for the next 3 years or so. And our sense is that, they're committed to that plan. They've tightened dramatically at the interest rate level, and this is another way to tighten, monetary policy. And a tight policy is the antithesis of what we've lived through in the prior 13-year advance.
This is quite a narrative that you've painted for us, Jeff. I really appreciate you showing us the structure and how this week, how this day fits into that much bigger picture. I love when in doubt, zoom out, which I jotted down, and I will use that and credit you, of course. Jeff Hughes, thanks so much for joining us today from Minnesota. Stay safe there. We'll talk to you again soon.
Always a pleasure.
That's Jeff Hughes. Jeff is the Chief Investment Officer, founder of JWH Investment Partners, coming to us from Minneapolis. Also, the editor of Alpha Insights, where he shares in a newsletter format some of these ideas. And what I love about Jeff and his work is that it makes me think. Whether or not you agree with a level, whether or not you agree with an approach, it definitely encourages me to revisit my own thinking, my own positioning. And for that, I'm very appreciative. Great take there from Jeff Hughes. Let's continue on our show today with our next segment, Getting Sentimental. We like to do Wednesday into Thursday. A lot of the sentiment data is updated. Let's take a look at what the charts are telling us about what investors are thinking, what they're voting, how they're voting in survey format, but also how they're voting with their capital. So we can look at positioning data as well. We'll start with the VIX. We'll start with the picture of volatility. And what's interesting about the VIX is that it shifts around, right? I'm hesitant, as always, to talk about particular levels in the VIX, only because those levels are fluid, right? So VIX of 20 or a VIX of 10 or a VIX of 30 means something in a particular period of time, what I'd call a volatility regime, but those regimes changed, right? So you can see in 2021, the entire range of the VIX was fairly elevated after being very, very low in 2019. I'm talking single digit lows. All of a sudden we rotated, and in the February, March 2020 period, spiked up. The VIX got up above 80. From there, we settled into a range between 20 and 40. That shifted much lower in 2021. We had that sustained bull market. This is when the FANG stocks were dominating, and it was sort of mega caps over everything else. Slow and steady increase. We rarely had a decline of more than 4 or 5% during that entire year, which seems hilarious now, given the declines we're faced with now. But the VIX overall was in a much lower range, between 15 to 25. Now in 2022, the entire range has shifted back up. It's much more like the second half of 2020. We fluctuated between 20 on the lower end and 30 to 35 on the upper end. So what's interesting is if you look at the chart of the VIX, in some ways it seems very straightforward. If you buy every time the VIX is above 30 and sell every time the VIX is below 20, overall, you did pretty well in 2022. You did pretty well sort of identifying those swings of 3 to 4 weeks at a clip, if not a little bit more, as we watch the volatility rotate. However, we have this sort of interesting environment now where the market's chopping around quite a bit. And so we've had these gaps higher to 3,800. We've moved much lower to 3,500. Now we're sort of right in the midpoint of that range, just above 3,650. The VIX, however, has remained elevated, right? It remains above 30. And what's happening right now is making me think a lot about what happened in April to May. The first time the VIX spiked above 30 was actually here in late April. The market chopped around a little bit, and then we had a couple more legs lower before we got to the eventual low in June. And the fact that the VIX has remained high, it's a lot less like January or June or even March, where you kind of spiked pretty high up to 30, 35, and then came right back down. And that was a confirmation that a market bottom had occurred. We're not really getting that pattern now. We're getting more of this elevated volatility, which has happened in more extended declines. And that's something I would be concerned about looking at the VIX. As long as the VIX remains above 30, this is a market that has not bottomed yet, I guess is the way I would describe the relationship of the VIX and the S&P here. The next chart is looking at survey data. Actually, the next two charts are looking at some survey data. Here we're looking at the AAII survey. This is a weekly survey of individual investors. And again, survey data in any form has its challenges, right? And as an undergraduate studying psychology at Ohio State, we were did classes on surveys and survey construction. And most of what you learned is that you can bias all the results super easily by just, phrasing things a certain way and all of that. So I take survey data with a healthy dose of skepticism in terms of the how clear of a picture it's providing. What's great about the AAII survey, however, is the fact that it's been run for so long. So even with all of its issues, you can look at what this imperfect survey is telling you now versus what it's told you at different times. And the participants in the market have certainly changed over decades, but the consistency of the survey can be really, really valuable to see how the current move relates to previous moves. With all of that as a long-winded introduction, where are we at? Bulls increased a little bit from just below, just around 20% last week to around 22.6%. Bears remain almost the same at just over 56%. So the spread between the two still fairly healthy, around 34%. The percent of bulls fairly low relative to the historical ranges, and the percent of bears at 56%, certainly one of the more extreme readings to the positive side that we've seen in quite some time. So having said that, this survey is very similar to what you saw back in April, very similar to what you saw in June, and very similar to what we saw in September. There's a healthy dose of bearishness, and much more bearishness that we've seen until you go back to things like 2008 and 2009. That's what concerns me about the survey, getting so bearish and remaining bearish. This reminds me of extended bear market phases, cyclical bear markets like you saw in 2008 and 2009, where you had a lot of skepticism, a lot of a lack of optimism on stocks, and that sustained lack of optimism was would allow stocks to continue to move much, much lower than you probably would guess. Next one is looking at the name exposure index. This surveys a group of money managers and asks what their positioning is. So it's essentially a percent allocation to the equity markets that you're seeing. So currently at 43%, well below the historical average, which is more around 70% for this data series. We're coming off of one of the lowest readings in history when we were down to about 10% here about a month ago. So overall, still a fairly low reading. And again, this tells me that money managers in this survey are still very much underweight equities. Look to see that to increase if you get a bounce. And the more that that's able to increase, the more that I would feel that there's a potential for a sustained rally beyond what we've seen so far. The RIDEX flows, which looks at where investors are allocated within the RIDEX family of funds, currently pretty high. This is plotted inversely. So the high reading of around 0.34 is similar to what we saw in the March 2020 bottom and also in the December 2018 bottom, but it's nowhere near the levels of positioning that you saw in 2015 or 2016, and certainly not in the bombed out markets in 2008 and 2009. So again, what encourages me about sentiment data is it's gone pretty negative. What does not encourage me looking at the sentiment data is that in extended bear market phases, these readings can actually get low and remain low. And I think a lot of people that are optimistic looking at the bombed out sentiment are looking at too little time, right? They're looking at historical data, which is during a cyclical and secular bear market phase. Compare the sentiment now to more secular bear market phases, and we could be nowhere near a bottom according to this data. That's it for sentiment, and we need to move on and wrap the show. The show goes by so quickly, I feel like, and it's unfortunate, but it happens. Let's go to the 3 and 3 charts that tell the story of this market in 3 minutes. Here is chart number 1. It's been fun reading Martin Pring's work recently. He's one of the best thinking about market cycles, the business cycle, and how you can apply technical concepts to those cycles. If you read some of his recent articles, he's using his KST indicator, which stands for no sure thing, which is a real long-term trend following technique. It reminds me of the Kopic analysis, or the Kopic curve, which is really long-term trend following on different asset classes. His comments recently have been on the relationship between stocks and bonds. And his comment is, when everything is going down, and this chart is showing you just very quickly the S&P in black. In pink, we have the bond ETF TLT. I have dotted lines just showing you gold and crude oil, but in green, we have the dollar. And essentially what we've seen year to date, which is what this time frame is doing it, is the dollar going up, commodities at times showing strength, but bonds and stocks just consistently going to the downside. So if you're a long-term investor looking at your retirement account and you're used to how your bond funds or your bond ETFs have basically been like this fantastic savings account that never loses money, that mirage has been completely dissipated in 2022 because bonds are having one of their worst years in history. The TLT is down big time along with stocks as well. There's been nowhere to hide except for limited places like the dollar and at times commodities. So why is this chart important? Because in this sort of environment, usually you would see strength from bonds first. Bond ETFs rotating higher means rates are starting to come down. That could provide the space for risk assets like equities to do better. So when I'm looking at this chart, I would be looking for the dollar to rotate lower and bonds to rotate higher. Then and only then would I start to feel more optimistic about the equity markets. Chart number 2, the chart of Home Depot. When I'm looking at HD, this is a key chart. We talked about Tesla yesterday, now testing support after earnings this week. Home Depot is another one of those big weighted names in the XLY, the consumer discretionary ETF. Home Depot is testing its previous lows. We had a low in June. We tested that low again in September. We are testing that low once again here today as we re-enter this blue shaded area. This could be a beautiful support level that holds, and Home Depot is a perfect buy that goes up to 410 again. However, given what I'm seeing from sentiment and breadth, I would see a much more likely scenario as that support does not hold and Home Depot goes lower. What would that tell you about the overall equity market conditions if a stock like Home Depot cannot find enough buyers to hold that previous support level? That would be how the S&P could get down to 3,200 or even further, as my guest Jeff Hughes today beautifully illustrated using the Elliott Wave principles. Can we finish on a positive note? I will always do my best to do so. Nice gap higher on some earnings today. LRCX's Lam Research, that's one of the semiconductor names. While semiconductors still have a lot to prove, and there are a lot of charts that are struggling in that space, nice move higher. I would love to see more of a sustained follow through, and that's why I think could be an important chart to watch. Folks, that's a wrap for this show. I want to thank Jeff Hughes joining us from Minneapolis. He's the Chief Investment Officer at JWH Investment Partners. Go to stockchartstv.com for all of our previous interviews. I'm Dave Keller. Have a great night.